Oh, you're an entrepreneur? Oh, you're a real estate investor? Oh, you're trying to learn from those who did it? Well, come into the lab then. Put your white coat on, gloves on, notepad, and let's build, y'all.
Real estate experiment. What is happening, y'all? Today, I have the pleasure of having Sarry, Ibrahim in the lab with me. Can you hear me okay, Sarry?
Yeah. Hey, Ruben. Thank you so much for having me on.
Hey, man. Of course. We were just talking about this, right? I want to. This is actually refreshing to have you here because, and I do this right on the air. I was saying, man, we just get right into it because we have a lot of real estate investors, we have a lot of entrepreneurs, and we talk about making money in real estate. We talk about a lot of things, and what's interesting is I don't have too many. I don't think I've had had one other asset protection guy come in here, and I think it's going to be really important, especially during these times, for us to understand how you can add value to our listeners. So the first thing I'll ask is, I always believe that you're a reflection, your business is a reflection of who you are. So let's get to know Sarry a little bit. What's the background? I know you've done it, theoretically, you've done it boots on the ground. This is what you do. If I met you on the airplane for flying together and I'm sitting next to you and I ask, what do you do for a living? What would you say to me, an elevator pitch, knowing that I'm a real estate investor? What would be that pitch?
So you know how real estate investors, the primary objective is to build cash, right?
Right.
I help them do that. I help them build cash regardless of market conditions while still having liquidity for real estate.
Smooth. By the way, I have to say, so I have a marketing background. I love how you said, so you know how. I don't know if you've read the book. You know exactly what to say?
Yeah.
Are you serious? You know him?
Oh, no, I don't. Sorry.
Do you know
him?
Okay.
But yeah, I've heard. So you know how you're right.
Yeah.
That is a very powerful marketing
it's smooth.
technique.
Because it explains it. But let's get a little bit granular. Let's talk about that, Sarah. So first of all, great. I'm impressed already. So I want to talk to you more. How can you help me? And if I'm in the room with you, is it I have to have a lot of properties? Do I have to just be a beginner? Like, at what point should I be talking to a guy like you? And by any means, introduce yourself. Like, what would people even go to you for? What are you? Who are you? Are you a financial planner? Are you more sophisticated than that? Like, what is it that you would present yourself as in the marketplace?
Yeah, definitely. So I am a financial planner. I founded a company called Financial Asset Protection, located in Chicago, Illinois. And pretty much I've been doing this total with other insurance and financial products for about 5 years now. I pretty much started off doing all of this about 5 years ago, and when I was in grad school doing my master's degree in business, and I was working at Allstate and a couple other insurance companies. And then I merged into the healthcare field while I was working with a lot of seniors in their retirement plans. And I was helping them merge from their own, from their company Medicare plans to their own individually owned Medicare plan. So that was my job for a couple of years, just making the transition, helping them, pick their doctors, pick the plan that would cover all those benefits. And then during that time, I started to build a relationship with these clients. And one of them asked me if I could help him with life insurance. And he even mentioned life insurance that has cash value that builds up over time. And I had no idea what he was talking about. But I told him I would do research for him and I would get back to him. So I went to Amazon, surprisingly, and I searched for books about life insurance. And I came across this book called The Bank on Yourself Revolution by Pamela Yellen. And the book pretty much talks about the strategy called the bank on yourself concept, or the bank on yourself strategy, which is the utilization of dividend paying whole life insurance. So what that pretty much means is that whole life insurance has two aspects to it. It has a death benefit, a life insurance part, and then it also has a cash value part, almost like a savings account within the policy. And the author goes in detail about this book and talks about how the cash value of this policy could do a lot more for you, not just life insurance, not just cash, but also guaranteed growth, liquidity, tax benefits. You could use it for your business, for your real estate business. You could use it for vacations. You could pretty much become your own source of financing and so much more using these types of policies. And then now I was completely hooked. So it had my attention. And at the end of the book, I decided to buy my own whole life policy in the bank on yourself way. And then there was also a part that they had a thing that said, if you're interested in becoming an advisor with us. And I went through that program. It was an 8-week rigorous training program, went through that, became a bank on yourself professional. And then that's where I found in financial asset protection. So our company is a financial services firm, but we mostly specialize on one concept, and it is the bank on yourself concept. And a lot of real estate people know it too as the infinite banking concept. It's pretty much the same thing. Both of them use dividend paying whole life insurance for wealth accumulation, for asset protection, for guaranteed growth, for tax advantages. And that's what pretty much ties everything up today and why we're here.
Okay, I gotta stop you because you first of all, I gotta give you credit because you dropped a lot of gems. And one is, I love this one. So I'm taking a step back, then we're gonna unfold. A client asked you a question, and you said, instead of saying I don't know, you said, let me find the answer. So first of all, huge kudos. And I think that's what entrepreneurship is all about. It's problem solving. And you couldn't have thought this out, not through your MBA. It happens and you're reactive. So I want to give kudos because we have a lot of entrepreneurs who step into the lab. It's real estate investors, entrepreneurs. And I think that's important to highlight that because that's where there's opportunities. And I think my team does social media. And it's funny, I think they posted something. We do social media for real estate investors too. And they said they posted this today, the bigger the problem, the bigger the opportunity. And for you, this is interesting because it's like, wow, I've never heard of that, but let me look for it. So first of all, I love that because I can resonate with that. I learn from clients all the time. They become partners. And I think you deserve that man a big shout out, or that man or woman, a big shout out. But good for you for taking action on that. So first of all, big kudos. That's important to highlight. Then take us, let's unravel that a little bit because I'm hearing a lot of keywords that I'm familiar with, but I don't even know how it all ties together. So I want to take a step back because I think a lot of us are listening and we know how to make money, but we don't necessarily know how to preserve wealth. And when you're saying this infinite banking dividend, I think you're making an assumption that a lot of us are that savvy. We're not that savvy. Let's take a step back. Why? Like, break down the traditional, and this is great because you have great background, right? You have like I think you said Blue Cross, Blue Cross, Blue Shield, Allstate. Okay, great. Traditional policy, life insurance. Okay, how is this different? Maybe break us down how like a traditional life insurance and how this one is very unique, and I think that will help us level set.
Yeah, good question. Yeah, so there's pretty much there's three types of life insurance. The first one is term, second is whole life, and the third is universal. So term is pretty much like, imagine renting a home. It would be for a set period of time. It could be for 10 years, 20 years, or 30 years. And pretty much when you have this term policy, you would use it for that specific time. You pay, like, for example, $50 a month, depending on your age, $50 a month for $500,000 in coverage, either for 10 years, 20 years, or 30 years. Once the policy is done, that's it. It's done. You don't get any cash value or equity from the insurance company. They pretty much promise to insure you during that time period. And there's nothing wrong with term insurance, but that's just how it's explained. Okay. And whole life has a life insurance part. It's for your whole life. It doesn't end. The only way it ends is if you stop making payments to it or if you pass away. But pretty much it's a permanent form of whole life insurance. It doesn't expire. And then the second difference also is that it has a cash value component, a part of the policy that builds up with cash value.
Can you unravel that? Because I don't want you to. You're so knowledgeable, and I don't want that to just fly over everybody's heads. What determines that cash value, by the way? Like, in you and I, if I'm, making 50K or this guy's making $250,000, like what can you help us out with what dictates how much cash value one is versus the other?
Yeah. So as you are, for example, funding the policy, you are doing two things. With every dollar that you're paying the insurance company, two things are happening. One is that it's going to service your life insurance. And the second is that you have like this savings account that's being built up. And typically with whole life insurance, the fees are going to be the highest in the first 2 years. So that means, for example, if I'm going to do a whole life policy on myself and I'm going to put $10,000 a year in for 20 years, year one, I'm going to buy, for example, if I'm putting $10,000 in, I'm probably going to buy around, $700,000 of life insurance. And as I'm putting in that money, maybe the first year, my $10,000 in premium would be about, let's say, $6,000 in cash value. So you were going to ask what happened to that dip. So I gave you 10,000, there's 6,000 in cash value. The 4,000 delta, the discrepancy between 4,000 and 6,000 and 10,000 goes to service the policy in the first year. Okay. The second year, it's another 10,000, but now the policy is going to start earning dividends and compound interest from the insurance company that it's with. So now what's happening is, as I'm paying this 10,000 into premium, the cash value is building up and it's earning dividends, it's earning interest, it's compounding. Eventually by year, probably 3.5, the cash value now is gonna outpace what I'm putting into it. There's gonna be a break-even point, and now it's almost like any other investment. Even though whole life insurance isn't an investment, it works similar. Now the cash value, the dividends, and interests are outpacing what I'm paying into it.
So in other words, it's almost like for those of us who might be familiar with like a 401k, it could be like a match, like a matching, right? It's matching even more than what we're putting in, or maybe double, or is that what we're talking about here?
Exactly. Yeah. Eventually the insurance company starts, paying, dividends and interest on your money, and then it starts growing. Now, the way it comes in as bank on yourself or infinite banking, the way it's different from other investments is that it's the liquidity aspect, the liquidity part. And what that means, Ruben, is let's say, for example, I have this whole life policy, I've been building it up, paying the premiums, everything's looking good, and I have $100,000 in cash value now. Now, let's say I'm also a real estate investor. So I come across a deal, I need $50,000 in cash. I have a couple options now. Option one, I can go to my checking account at the bank, take $50,000 out. Or option two, I could borrow that money from somebody, either a hard money lender, private money, or a bank. Or option three, I can go to my whole life policy and borrow $50,000 from the policy.
And now, can I ask you a question real quick?
Yes.
Let's say that number is $100,000. Would that, when we say a cash value, that's essentially what it's gotten to, like that includes the match. Can we just say matching so that we can understand a little bit? Let's say it's just because these are such new terminologies. I'm getting so excited, but I don't want to butcher it and say the wrong thing. So I'll speak my language. But so that cash value was contributed as a quote unquote match by the actual policy itself. It wasn't the original amount that you put in. Am I correct? You've leveraged in other ways that amount. Am I correct, or am I incorrect?
Exactly. Depending on when the policy started and how much was started with it. Yeah, the $100,000 I'm referring to is a combination of your dollars plus dividends plus interest from the insurance company, all combined together.
And now I can borrow on that. I think that's key.
You can borrow up to 90% of that.
Wow. So this is like I think some of us might be familiar with a line of credit, but this sounds like this is like a line of credit on steroids, because, well, yeah. I mean, am I right? I don't know if I'm trying to come up with these analogies because this is such a new concept to me. And I think sometimes it's important to like give people a little bit of that. And I think you're doing a good job, by the way. I'm trying to like piece it together in my mind. So is that where we're at right now?
Yeah, you're right. It's a line of credit essentially that you have. And for example, let's say, I have $100,000 in cash value, and I'm going to borrow for myself. I'm going to bank on myself. I'm going to go borrow $50,000 from the insurance company. Now what happens is, Ruben, I have the $100,000, in cash value, and I borrow $50,000 from the insurance company's general funds. I'm taking $50,000 from the insurance company as a personal loan, and then I'm leveraging my cash value. I'm not deducting from the principal. Now I could take this $50,000 loan, go put it into real estate. Now it could be, different types of real estate, but let's just say it was I bought it, flipped it, and I churned that 50,000 into 75,000 in 6 months. Now what happens is, while I was doing that, my cash value was building up, earning compound interest and earning dividends. So by the time I pay back the loan, and I could pay back the loan on my own terms, I could pay it back monthly, annually, I could pay it back over 5 years, 10 years. As long as I pay back the loan, I could do that. I can control the payback period with the insurance company. Now, while I'm doing that, I'm making compound interest on my money and, of course, making a profit in real estate. So this way, the money is doing two things for you at the same time. It's earning interest in the policy still, and it is working for you out just like any other investment would work for you. And the cool thing is that, if you remember earlier, I said I could have used $50,000 in cash, but I prefer to use the policy, to borrow from the policy and to pay it back, because if I use $50,000 in cash, I could never earn interest on that money anymore. But if I leverage the policy, I could do both. I can have an increase in wealth using compound interest while also having the liquidity. So I'm not tying up money for 20 years or 30 years and never touching it again. I'm using the money over and over again, while still earning compound interest.
Okay, so two clarifications, because I thought you were talking about the other 50K that's left over. Are you talking about the 50K that you're actually borrowing is still getting interest, or no? That couldn't be possible.
So there's 100,000 right in the balance.
Yeah.
I borrowed 50,000 from the insurance company. It has nothing to do with the $100,000 cash value. It's the 100,000 is pretty much the equity. It's just nothing happens to it. I'm borrowing against it. I'm not subtracting. And then
you're borrowing against it.
Exactly. Yes.
Oh my gosh, my brain is just like, Wow. Okay. That's nuts. So hold on. When you're borrowing against it, here's another question. I'm sure the listeners, as they're listening to this, I'm like, when it's too good to be true. Okay. All right. What is the interest that I can be expect? Because I'm sure there's people who are listening to this. Okay, my hard money lender, like I'm borrowing 100K, 200K, whatever, and it's 2 points and 8. Okay. What does that look like to give our listeners some form of perspective of why this tool might be a way better tool to use than maybe some other traditional or untraditional financing or private money?
Yeah, absolutely. So it's so a couple things happen. When you borrow the money, you're borrowing at a maximum of 5% simple interest. And then when you pay it back over 4 years, what happens is that turns into about 2% APR. But while you're doing that, you're earning on average between 5 and 6% compound interest on your money. That's the dividends and interest. So it creates a split. So imagine if you have, this supercharged savings account at a bank, and you're earning 5% compound interest on that money. And let's say you have $100,000 in there. If you go to access money, if you go to access, $5,000 from it, you're actually taking out more than 5,000. You're taking out the 5,000, the principal, that amount, plus the loss of opportunity cost you could have earned had you have kept that money compounding. So the logical thing to do would be to borrow against it at a lower interest rate. This way it creates an arbitrage. You're earning money on money while still having access to it. So you would borrow, for example, at 2%, earn 5%, the split would be 3%. And you still have, the liquidity to the investment. And I'm not making this stuff up. This is what banks do. This is what banks and large corporations do. They have billions of dollars in cash reserves, and they earn interest on that money. And then when they need to use that money for payroll, for expansion, for taxes, for whatever, they borrow from different sources at lower interest rates, creating this split where they're earning money on their money while still having liquidity. And I think that in business, a lot of business owners, and I've seen this with my clients, is they kind of lose focus of saving up cash. It's all about building a business, more business, bigger business.
Yeah, offense. We're playing offense all the time. That's why I want you on here. I'm like, this almost sounds like, and I don't mean to cut you off, but you're making such a good point. Sorry, it's like playing offense and defense. It's crazy, right? I just gave you some branding right there, man. Like, that's you right there. We play offense and defense for you at the same time.
Yeah, I like that. Yeah.
Got you, man. That's what's up. So, okay. So thank you for that. And I know I interrupted you mid-thought, but I needed to make that point. It's really important. So if to help you get back on track, originally we were talking about, okay, I could see why it's better than traditional, but so that was life insurance on like steroids, right? And so bank on yourself. Is there more to it? I mean, this is enough. Like, I don't think you need to add anything else, but I'm just like soaking it all in. I'm like, you're throwing in all these things. I know there's tax deferred. There's a lot of stuff that you can't, I want to hear all the juice, man. What else should I be writing down and then following up with you and your team on, because we need to figure out more. What else? What are some other benefits that we're totally sleeping on as investors playing aggressive offense?
Yeah, so I think with investments, you need to ask yourself before you look at the rate of return or alongside the rate of return, you need to ask yourself other questions. Like, number one, what is the tax liability on this? Am I paying taxes every year? Do I pay taxes in the future? Do I pay taxes now? Ask yourself, what is the tax liability? Number two, ask yourself, how much does it cost, aside from the rate of return, but how much does it cost to maintain this investment and the service fees along with it? And then number three, ask yourself, what is the liquidity like? How can I access my money anytime? Are there penalties? Are there fees? Do I have to wait a certain amount of years to do so? And then the reason why I bring this up is because when you, and then also think about the risk too, the risk and associated with it, the historical risk behind this type of investment. And the reason why I'm mentioning these things is because with whole life insurance, number one, as far as risk, we only work with mutual insurance companies that have been around for over 160 years, who have been paying dividends and compound interest to the policy owners and death claims and everything alongside with all the promises they made for over 160 years. So there's a lot of certainty, and they've been able to do this during the Great Depression, during the 2008 crash, during coronavirus pandemic. During all these times, they've still been able to pay out the dividends to the policy owners. So I think it's very important for a lot of real estate investors to think is your cash has to live somewhere, but make sure it lives somewhere that's safe and that's predictable and that offers guaranteed returns. Also, too, as far as fees, we already talked a little bit about the fees. The fees are typically the highest in the first 2 years. And in my opinion, that's a good thing, because what happens is eventually over time, while earning dividends and interest, you eventually recoup the fees that you pay to the insurance company in the first 2 years, plus interest, plus more. You get your money back, plus more. Other investments, like more of on the traditional side, passive side, excluding real, I'm not talking about real estate, but other types of investments. As your account is growing, the fees are growing alongside with it too. Like in 401ks, IRAs, other plans like that. And it's not to bash those. It's just kind of something to bring to the attention of the real estate investors and the business owners, is that think about how much does it cost, and aside from the returns, how much does it cost to maintain this? And of course, we talked about liquidity already. It's not an either or approach. It's not either I do whole life insurance or I do real estate. It's kind of a both and strategy, where I could invest in real estate and build up a whole life policy, and I could use the whole life policy for real estate, and then I could use real estate to pay for the whole life insurance, and then back and forth.
God. Yeah, no, I think one of the things that I said opening up the show is you're very selective in your speech, and I respect that, because I think it's powerful. This is why I host this show. I'm listening all the time, and you said alongside, and I thought that was, and you were very key on, and I want everybody to listen to that. It's just alongside, right? You're already doing things, but alongside what you're doing, take into account, and I'm definitely taking into account, and I'm definitely taking your card. But you're on my show, so I'm glad you're making me look like a rock star right now, because I'm like, okay, so that's amazing. I want to, and so I do want to ask you this. I'm wondering, and it seems like, you talk about hard money, you seem very well versed into, your clients in real estate. So I'm curious, do you know, and it's okay if you don't, just because there's real estate is such a large umbrella. There's that quick money, like flipping, and then there's like your typical 30-year mortgage. That's obviously, folks have seen interest rates go down tremendously. But I'm curious, when you're speaking about these numbers, I'm looking at the flipper like, hey, look, I mean, we actually just closed on a deal today with the real estate development partners. I was actually helped on the acquisition and selling side. Experiment Nation knows that, work with developers, but we're talking about holding costs of like 4 to 5 months on a flip. And I mean, I know these guys are probably getting some competitive numbers, but I mean, from what I said, and I'm sure we shouldn't quote you on this, but we're saying like what, 5%ish? Is that what you're kind of saying? Because then I'm thinking, where I'm going with this, kind of a long-winded kind of comment and question I'm asking at the same time. But where I'm going with this is that would completely dominate like any hard money lender, from what I'm hearing, unless you got some kind of private money deal. Like 5%. And you're earning on that? Is that what we're looking at typically? And do you find that some of these folks or real estate investors are typically those who are looking to do maybe fix and flips and are looking for the upfront money and then pay it off?
Yeah, of course. If you do have the cash value, if you have the cash value available, yeah, absolutely. Not only is it a 5% simple interest, but you're also earning money on your money. Whereas, with other sources, you're paying interest to other people, either to the hard money, private money, or the banks. They recoup the interest, but you're not recouping interest to yourself. So when you end up using your whole life policy as a source of financing, as your own mortgage, essentially, what happens is that it's almost like negative interest. Like you're getting, below zero interest rates, because you're earning 5% after 4 years, 2% APR. It creates this split, the spread. That I think is super important. It's not just about, trying to find the best interest rate, but also what's happening with your cash while you're using your cash. I think that's key to understand.
Wow. Well, first of all, thank you so much. I can't even thank you enough already. Like, so what do you think if I'm listening to this right now, and obviously there's two types of people. They hear something, they take action, and then there's a person like, yeah, maybe that's not for me. Why? Who is this for? Is it everyone should have it? Is there a certain level where you should start thinking about this? As I'm dropping my phone here, even the phone's trying to, like, this is crazy. It's freaking out. So, who should be paying attention to this? I think I asked this in the beginning. Is this for everyone? Is there a specific person in your avatar or client that you feel is really resonating with this message the most from the folks that you've worked with?
Yeah, definitely. So the good thing about this is there's no really minimum, like you need $100,000 a year to do this. It could be for anybody. I started my first policy with $300 a month. I worked with clients who started the same thing for $300 a month, younger clients. And then I've also worked with clients who've invested $500,000 through a single premium whole life option, where it's just a one-time single premium case of $500,000, So I could pretty much build out a solution for anybody, whether they're, still in college, they want to save some money, or they've been investing in real estate for the last 30 years, There's solutions for both. And I think that what we always do with our clients is we do like a full, thorough 60 to 90-minute financial analysis. And it's pretty much us just asking questions, seeing where they're currently at, seeing where they're financially at, their objectives, needs, wants, long-term goals, short-term goals. I think we built out the policy based on that. And I don't think there's really no requirement that you need to meet, but there is a quality that people must have in order for them to, I think, agree with this and follow along with it, is that it has to be a long-term strategy, number one. And number two, it's a mindset shift. Instead of going from the retail investor, retail consumer, you're going to thinking like a bank, where do I park? Where does my money live? And there's a keep growing even when I'm using it. That, I think, is the differentiator between, because a lot of people, what they'll do is they'll say, all right, which investment has the highest rate of return or the highest ROI, and I'm going to go there. It's almost like they're shopping for investments. And this strategy is not like that. If it was like that, I'd probably be out of business, because there's so many different variables involved. It's more of a mindset shift. It's something that's long-term. If somebody puts in, for example, year one, they put in 10,000, they only have 6,000 in cash value, they're going to think that's a terrible investment. But it's not about the first year. It's about the next 20 years. And it's also about creating a hedge against what's going to happen in the future. Because if you remember in 2008, a lot of real estate investors, what they were doing is they had, all their equity tied up in properties. And then when they want to buy new properties or take out cash, they would just borrow against it. And it was fun. You just keep borrowing against it. You have all these properties, and then you can keep doing that. The banks would give you the financing because they have the collateral. But then when the market crashed, the market values crashed. So that means that, and then banks also lost a lot of money. Banks closed down, banks were removed, went out of business. So what happened was that there was a liquidity crisis where banks weren't even around to give out lending. And then even if there were banks around to give out lending, then they would give you a loan to value at market value, not at what you paid, but at loan value, at market value. So if the market value diminished, then your ability to borrow is going to diminish. Again, creating more and more, it's like a cycle of liquidity issues. Now, when you have this whole life policy, this whole life solution in place, even if there is another recession or depression, the cash value in the policy and the ability to borrow will not be hindered by those external factors. Meaning your market value doesn't dip because the S&P 500 dips or because the real estate market dips. You have something that doesn't connect or correlate with the stock market or the real estate market or any market for that matter. It keeps compounding and keeps growing. That's one thing. And the second thing is, because we're dealing with insurance companies who have gone through already the worst conditions this country has seen, they'll still be around for liquidity to be able to borrow from them. And there's no financial underwriting involved for borrowing. So you never have to come up with a credit score, come up with a cosigner, come up with collateral.
Not like refinancing or the crazy headaches of underwriting. Jesus.
Exactly, yeah. And Ruben, one of my favorite quotes from Mark Twain is, a banker is a fellow who will lend you an umbrella when it's sunny out, but wants it back the second it stops raining. Meaning that banks only deal with people who have money or have collateral. And when they don't have the collateral, when they don't have the money, when they don't have the proof of income, they want their money back or they'll deny the loan. Yeah,
it's easy to bank when you're rich, put it that way. Wait, so this is so cool, man. Okay, so keeping it real segment right here. This is important because you have a business model within the space, and I always say the best way for you to be able to do business with me, and I say that to people, is for them to understand. If they don't understand how you even make money, then it gets kind of like, okay, like who, for example, if I'm raising capital as a syndicator, I need to know, hey, I'm going to take a 2%. I gotta really structure it out. And I'm not a syndicator, by the way. I'm just putting it out there. So for you, I'm very curious in this field. How are you monetizing? How are the big companies monetizing? And I think the insurance industry is actually very, very savvy, actually. And I think you guys are offering tons of value. But I'm curious, if I want to understand you guys a little bit better, how do you guys make money? Mm-hmm. Just so we understand your business model and so the listeners also have full transparency.
Yeah, good question. Yeah, I love that question. So typically in the financial services world, it's for the most part split up into two sides. One side is fee only, meaning that you're paying either a fee on the account that's being managed, or you're paying somebody a fee to set up the account for you, like a consulting fee, like it's the same thing as kind of like you're doing your taxes, like you're paying somebody to do the taxes for you. And then the other side too is commission, where you're working with insurance companies and financial institutions, and they pay you like a commission for bringing the client and for servicing that client. We are on the commission side. So that means that if we set up an account for somebody, a whole life policy, we don't charge any service fees or consulting fees, number one. And number two, we don't charge an annual, 1%, 2% recurring annual service fee just for managing that account. We get paid from the first year from the insurance company via commission. That's it. And then we do 6-month reviews for the client. We don't charge for those 6-month reviews. We don't, if the client has cash value in the policy and that's inclining in value every year, we're not tagging along with that in terms of fees along with that cash value. We get paid in the first year commission from the insurance company. Also, the commission is not added onto the premium. So that means if somebody decides to do $10,000 a year, we get paid commission from that a portion of that 10,000 from the first year, not 10,000 plus 2,000, and then the client pays 12,000. It's already wrapped in there.
That's interesting because I know I've done some consulting, and again in a different phase for an insurance company, so I'm very familiar with fiduciary, all that cool stuff. And it's interesting because I guess, and I always try to make it as simple as possible for our listeners. Is it almost kind of like you're brokering policy plans so that you're, hey, Ruben, this is who you are, or Sarry, this is who you are, and based on what you've told me, here's what I can advise, and I'll get the commission off of that, and then you're in their hands? Is that how you're doing it?
Yeah, and that's a good, interesting thing that you bring up the brokerage part, because we are a brokerage, so we're not captive to one insurance company. We use primarily for the bank on yourself strategy, we use 3 insurance companies.
Oh, interesting.
And with that, and I actually built the practice intentionally that way. I want it to be independent because I never want to be in a situation where it's a conflict of interest, because what could happen is, somebody could be listening to this podcast, right? And they go, oh yeah, you know what? I want to do whole life insurance. I want the dividends. I want the interest. I want the liquidity. I want to use it for real estate. And then they can call their insurance agent, their, I don't want to say any names, but let's just say they called ABC Insurance Company. And then ABC Insurance Company doesn't have whole life insurance, or it's not a mutual insurance company and it's not applicable with the bank on yourself solution. Now what's going to happen is that agent, ABC Insurance agent, now is captive to that company. And either one of two things will happen. One, they'll say they're not familiar with it. Or two, if they are familiar with it, they'll say, it's a bad idea. They'll have to sell against it because they can't
or push you towards something that's similar, but that's really not similar.
Exactly.
Right?
Even worse. Yeah, exactly.
Yeah.
They might do a variable.
Yeah, but we have this. Yeah. No, I think it's so important what you're saying. And I always say this from a real estate perspective. If you're listening, this is very similar to the lender that has their own terms versus a broker who can shop around and get paid a commission for finding you the best loan for you. That's how that you do not pay that. They get paid by the vendor. That's what their job is, to find the best one for you. So they can shop around versus a lender will only, and again, shout out to you guys know I love y'all guys all. You guys help me. But there's a defined difference, and it's important that you get educated the difference between a broker and one who is in-house. And I think there's a very similar, and kudos to you for structuring your business in a way that allows you to have flexibility and total flexibility for the best interest of your clients.
Yeah, absolutely. I never want to put myself in a situation where I have to put the insurance company before the client. Client comes first, and unfortunately, that's not how it is most of the time. And it's just something to look out for. Nothing wrong with captive insurance agents at all. But I think when it comes to this strategy is that there's particular things about the strategy that have to be taken into place. Like number one, it has to be whole life insurance. Number two, it has to be from a mutual insurance company as opposed to a stock-owned insurance company. So mutual insurance companies give their dividends and profits back to the policy owners, whereas stock-owned insurance companies give their dividends and profits back to shareholders. So it has to be mutually owned. And then there's something called the paid up additions rider. So you have to make sure that the company even offers a paid up additions rider. Not all whole life insurance companies do.
What is the last thing you said? Paid, what is it?
Paid up additions rider. It's a piece of the policy. It's a part of the policy that helps turbocharge the cash value. It helps build up that cash value. Without the paid up additions rider, you will have a very slow, interest earning whole life policy. And this is typically when people hear the word whole life insurance, when they hear that term, they think of very small returns, low returns, high fees. And they are partially correct about that, because it could be a policy that's 100% life insurance only. There is no paid up additions rider. So you need the paid up additions rider with the bank on for the bank on yourself strategy. It has to be, it's needed for the rapid growth.
So it's whole life. 3 pillars are whole life insurance, mutually. What would you call it?
Mutually owned.
Mutually owned, and then paid up additions rider.
Yeah, and there's a fourth one actually too.
So he's got some juice, y'all. He's got a fourth one. This is exclusive. We might have to make this the paid section. Give us the secrets, Sarry.
Arguably, the fourth one is the most important one. It's something called non-direct recognition versus direct recognition. And you want to make sure that it's a non-direct recognition company. And what that means is, if you remember earlier when we talked about having $100,000 in cash value, you borrow $50,000 from the insurance company, you pay that back on your own terms. But while you're paying that back, while you're using that money, you're still earning compound interest on your money. And that's because it's a non-direct recognition company. The company is not recognizing that loan, and they are paying you compound interest and dividends on that money. If it's a direct recognition company, what happens is when you borrow that $50,000, they reduce the dividends and interest they would pay you because you have an outstanding loan. So you need to make sure it's a non-direct recognition. And I think that's the most important part to it, is that imagine if you had like a house that was worth $500,000, you borrow $100,000 from, line of credit or another party, leveraging your $500,000 house. You're not subtracting from that value, right? You're borrowing against it. Same thing here. That's where the non-direct recognition comes in, is that your value continues to grow even when you're leveraging it.
Guys, you're going to have to follow this man right here that's standing. If you're listening to this, do not stop and try to double. If you're driving, we're going to have everything in the show notes so you can connect with this wizard that just fell. It's like heaven over here.
Thank you.
Towards the end of the year, I think this is such a good message. I always like to, I want to ask you these rapid fire questions because you're an interesting guy and you're doing some really interesting things for people. And that is, I got to ask you, you talk about books before. Name one of your favorite books.
Mindset by Carol Dweck.
Am I surprised? Change of mindset right there. What's this best habit, the habit that serves you the best?
Checklist, writing checklists every single day and checking things off, even if it's a very boring task to a very complex task. Checklist all the time.
What do you use for that? I'm curious.
Just a notebook and just checklist. That's it. I've seen apps. I've tried to use them, but I'm kind of old fashioned.
No, I'm the same too. Like I'm very visual. And what I was gonna say is I'm using like the Atomic Habit Journal. You might appreciate that because you're a sharp guy. So okay, interesting. Biggest misconception that you think people have about whole life insurance?
Oh, it's biggest misconception is that it's a terrible investment, and I think that it could be a terrible investment if it's from the wrong company and using it for the wrong purposes. It's about taking the cash out of it, building it up and using it with alongside other investments. Not just whole life insurance and nothing else.
Interesting, very very insightful. Best thing you wish you knew, maybe like 5 to 10 years ago. It doesn't matter. The earlier would have been the better for you if you had known that one thing.
Yeah, ironically, I was thinking about this today. I wish I got into all of this earlier. I wish at least not even about the entrepreneurship part, but mostly about just communicating with people and just I don't like to use the word sales, but kind of just from the perspective of like convincing people. I wish I started doing that earlier, like when I was like 20 years old or even like younger than that.
Well, look, it seems like you've been doing it. I told you your opening was fire. It was like, hey, man, so you know how? I was like, okay, this guy knows what he's doing. But yes, absolutely. I think we're all in the business of sales, whether we want to admit it or not. And I do not, you're at a safe place here at Experiment Nation because sales you're with entrepreneurs. We understand the value of that. There's nothing wrong about selling anything.
Of course, yeah.
The thing is, if there's something wrong with if we put it this way, if you're not selling something, then it's not worth it. If you're selling something that it is worth it and you believe it can impact people and change people's lives, then you should be selling it. It's your duty to sell it. So kudos to you for that. And I got to ask this question. This is brought to you by Invested Talent. How important has social media been for you?
Oh my God. I'm actually not active at all except for LinkedIn. And it's been awesome. A lot of hosts will reach out to me and we'll book podcasting that way. And actually, believe it or not, Ruben, and not to brag, but this is just something like an accomplishment I want to just share. This is
it's an experiment. When you're in the lab, it's an experiment that has gone well. That's what it is. You got your lab coat on. Don't forget.
And believe it or not, but today is my, I think, 74th guest podcasting since the summer of this year. So in like the last 6 months, 74. A lot of it due to LinkedIn and email marketing.
That's some strong stuff, man. I got something that's gonna blow you away. I'm so excited to share with you. Like when you got on, because I just discovered it today, dude. You heard it here first, guys. I'm dropping it, gems. You know anything about Clubhouse?
Clubhouse? No.
Oh, I'm so glad that was your reaction. That was my reaction today, brother. I am telling you right now, it's gonna change your business. To anybody who's listening, I'm giving the plug away. It's invite only. So I'm gonna have to get you my invite today. But actually, I think I wait. So it's a beta platform right now, and it's like it's a room where a bunch of people go into a room. It's like a Zoom meeting, but it's an application. There's no you have a profile, and there's a bunch of rooms with different discussions. It's a beta app right now, and the biggest people in the space, the early adopters, are on it, and you're getting tons of flooded traffic. I have a buddy who's in the real estate space. He's like coaching as well. He's like closing, like he's getting students from that. And I just tried it. I'm gonna actually hop on it as well after this call. So this is December 30th. I just shared this with Sarry, and you can tie in I think there's right now it's Twitter and Instagram, but it's for the kind of level of expertise that you're talking about. I think any topics like the one you're talking about right now, it needs to be communicated with so many people, and they really need to go deep dive on it. And I think you're the perfect person for it. So I think that's going to serve you really well, my man. And I'll share those details with you offline. But yeah, thank you so much for coming into the lab, dropping value, dropping gems. You're putting the word out there. You're helping people. You're changing their lives. You're changing their financial situation. You're having an impact, and you're doing it in a very good healthy business model that allows you to grow as well, your company, which is really phenomenal. So I can't wait to see. I'm going to bank on yourself. I'm banking on you, man. So where else can the people find out more about you? I know you talked about LinkedIn. Tell the people where we should be following up with getting to know this concept that I think everybody should know, including myself. I'm sold. Where do I sign?
Yeah, definitely. So you should. I think everyone should read the book, The Bank on Yourself Revolution by Pamela Yellen. That's one book to read. The second book is Becoming Your Own Banker by Nelson Nash. Nelson Nash created this whole concept. So it's pretty much check out the book, Becoming Your Own Banker. And then also, if you reach out to us at finassetprotection.com, it's FIN assetprotection.com, you could schedule an appointment there. And if you schedule an appointment and you say you came from Ruben's podcast, I'll send you a free copy of either Becoming Your Own Banker or Bank on Yourself Revolution, whichever one you want, for free.
That's awesome. Definitely. I will include that in the show notes, my friend. And again, cannot thank you enough for adding tons of value. And just like that, we are out.